Welcome to Bloomberg Law on Demand. I'm Pacchia. 2 weeks ago, Centro Properties Group agreed to sell Blackstone its U.S. shopping centers for $9.4 billion. Joining us today to discuss the transaction and what it means for the commercial real estate market, I'm happy to say we have the co-head of the restructuring group at Skadden Arps, Jay Goffman. Jay, thanks so much for coming in today. Welcome to the program.
My pleasure. Thank you, Lee.
So before we get to the deal specifically, I was wondering if we could go through a little bit of your background. You started out as a young bankruptcy attorney working for Harvey Miller, one of the lions of the practice. What was that like being at Weil Gotshal in the early days?
Well, it was interesting. We had a lot of great transactions. I was there throughout most of the 1980s, and I worked on many of the major cases: Texaco, Sunbeam Allegheny, Eastern Airlines, Continental Airlines.
Formative years in the bankruptcy bar.
All the formative years, when the whole practice of restructuring was just evolving and starting to change.
It was interesting. Before we were talking about, after you were at Weil, you went to Bear Stearns to spend a little bit of time as a debt trader. What were those years like?
Yeah, I actually left in the middle of the 1980s to go trade distressed debt for a short period of time at Bear Stearns. It was the early days, and very few people were doing it, but we had the idea back then that you could buy debt, convert it to equity, fix the companies, and then take them public. And ultimately, I came back to the practice of law, but what it allowed me to do was realize that restructuring should be more of a business transaction and less of a litigation. And frankly, that was the whole genesis behind creating the idea for Prepex.
It's interesting because the debt traders, as so often said, changed the face of practice over the last 20 or 30 years in bankruptcy. So you've seen a lot in your years, and now, of course, you're running the group at Skadden. Tell us a little bit about the Centro deal. How did that transaction happen, and what's it ultimately going to mean?
Sure. Centro is a terrific transaction. Centro is an Australian stock exchange-listed company. It's one of the largest property developers and managers in Australia, as well as the U.S., and they had about $20 billion in debt in total, split between the Australia and the U.S. And a couple of years ago, when the economy had problems, Centro had some debt coming due, and we knew if we restructured at that time, it was going to be a problem because there was no liquidity in the marketplace.
The world was on fire in 2007.
Exactly. So we got the banks to agree to extend for 2 or 3 years, buying us time to get to the next phase, and that's what we were doing this year. And we decided to look at both restructuring options and sale options. And frankly, we're at a good place in the marketplace where people are now seeing they believe the bottom of the market has hit already in the commercial real estate section. So people are willing to buy assets. So instead of having to restructure the U.S. businesses, which had billions and billions of dollars of debt, we were able to run an auction process, get a bid for $9.4 billion, which allows all the debt to get paid off, and send money back to Australia to finish the process there. So it worked out actually the way we planned it. We said, as fortuitous as it is.
It's nice when it happens.
You buy time, you hope that the markets change, and then you hit the markets when they come back.
How has the valuation been received in your community?
I think people have thought it's a terrific transaction. We think we have gotten a fair price. It's a fair transaction for everyone. And what it shows is that people really believe the U.S. commercial real estate market is about to move on an upswing.
Right.
People with money in private equity are putting it in, and people putting in money in bank financing are willing to finance the transaction.
That's where I wanted to go next. Blackstone essentially is making a bet that commercial real estate is due for an uptick. We've spoken a lot on this program about the problems facing the residential real estate markets. It doesn't seem to be quite as bad in the commercial space.
Yeah,
is that true?
Yeah, I believe so. I think residential and commercial are just two completely different marketplaces. Well, I think residential has more to do with the GSEs and how they finance the transactions. And what you saw in the residential area was you saw all these loans put together and securitized, and the credit quality of some of those transactions just wasn't as good. The commercial market is really tied to the business market, and people believe the U.S. economy is on an upswing. So, yeah, in a certain sense, it's a bet on the economy and a bet on the commercial real estate market. But The guys at Blackstone are really smart, and
Right.
I think they've
been doing this a long time.
I think they're probably making a very good bet.
Right. So if the main driver for the residential space is the GSEs, Fannie Mae, Freddie Mac, we say for the commercial space, the main driver is QE2 and whether the government's going to continue putting money into the system?
Well, I think it's QE2, and I think you're just seeing. I think there's a belief that the worst has passed, that money is there both for investment on an equity side, and the money is flowing back in from the pension funds into the CLOs, which is making the bank financing market strong. So I actually think it's the difference between times when you restructure businesses and times when you refinance businesses all has to do with the amount of liquidity, and the liquidity is actually being driven by the pension money that's flowing into the marketplace.
Mm-hmm. So if the Centro deal marks the beginning of a sustainable uptick in the commercial space, what's different this time around? Has financing shifted at all? How are these deals going to get done?
I mean, the truth is that the financing you're seeing today is very similar to what you saw 4, 5, 6 years ago. You're starting to see more highly leveraged transactions. You're starting to see some covenant-light deals. So, and again, that's a factor of supply and demand. You're seeing cash flow come in from the pension funds to the CLOs. They're looking for yield, so there's more money to finance. When there's more money to finance, the terms get better. But what you often see, it's a question of where in the business cycle are you. Mm-hmm. When you buy at the beginning of an uptick in a cycle, those transactions are usually very good. You're buying the quality companies early on at a fair price. Companies get into trouble, or transactions get into trouble when they buy too late in the cycle, and they're overpaying. And often at that point, they're overpaying for the business. And if you catch it as it's starting to hit the downswing, those companies inevitably get restructured. They always say you make money on the buy, not on the sell.
Jay, while we have you here, I'd like to ask you a couple questions about some of the other cases you worked on.
Sure.
You represent Dish Networks. They were recently involved in the DBSD case. We saw a pretty solid result for everyone involved in that case. The assets of the company were sold for something like $1.5 billion. They thought it was going to be sold for about $1 billion previously. What are your thoughts on how that case ended up? Is everyone as happy as they seem?
I think everybody's thrilled by it. There was a plan of reorganization over a year ago where the court valued the company at about $600 million based upon expert testimony. Mm-hmm. And with the passage of time and creating a forum where people could actually step up and bid and put real cash on the tables, so you didn't have to worry about expert opinions, we got to see where the real values are, and the values went up, and we were very pleased to win the bid yesterday at $1.4 billion.
We've seen this happen before in Chapter 11. It's the process itself almost seems to have the effect of increasing asset prices. Almost, well, not to say the longer they stay in the system, but certain times, the longer they seem to be in the process, it seems to increase the price.
Sometimes yes and sometimes no. I would tell you as a general rule, you don't want to linger in Chapter 11. It's a place to get in, fix what you need to fix, and get out.
Right. There seems to be a lot of places you can get hurt.
Because bad things can happen, the markets can close, the financing markets can change, and you might not get out. There are certain circumstances, however, where with the passage of time, values just go up. And as long as in Chapter 11, sometimes you can get a better price, because you can set a process where people know there's going to be an auction and people bring their bids to the table. And you also know you're buying the assets free and clear of liabilities, except those you're assuming, so you know you're getting a clean company. So it can be a good process to create value, and sometimes you stay in and the markets turn in your favor. As a general rule, I would say get in, get out.
Also wanted to ask you about MGM. You're part of the team that advised the debtor in that case. Where does that case stand now?
MGM was a terrific restructuring. It was the largest pre-pack ever done in under 30 days. We converted $5 billion of secured debt into equity. And we came out with a new $500 million liquidity facility. The company's fully reorganized. It's out there. It's making new movies, and I fully expect to see it at the Oscars one day again.
There were reports that the studio was considering selling off some of their franchise properties, like the Bond franchise or the Hobbit franchise. Did it ever come close to that point, or what happened there?
No, we were never going to really sell off Bond or the Hobbit. We did look at the alternative of selling off the entire business to see if there was someone that wanted to invest, because you always look at both options. But no, the Bond and the Hobbit are true franchise makers. You hold on to those.
That must have been a cool case to work on.
That was one of the great cases. I've been very proud to help restructure a lot of businesses over the years, but MGM is the one case that everybody remembers.
Right on. Jay, thanks so much for coming in today.
My pleasure.
Appreciate it.
Thank you.
That's Jay Goffman. He is the head of the restructuring department at Skadden Arps. If you'd like to learn more about the issues we just discussed, go check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. I'm Pacchia. Thanks for watching.